Excitingly titled A User's Guide to Restructuring the Global Trading System, the Stephen Miran, or is it pronounced Miran, document written in November 2024 hasn't had much attention in Oz, which is a bit surprising as it describes the current Trump playbook with respect to tariffs and trade, allied with America's now unaffordable security burden and fiscal deficit interest payments. Alternatively, cynics would say this is the greatest job application ever, with Stephen arising from obscurity to chair of the Council of Economic Advisers and now on the Fed board, possibly as Trump's Uberdove. Whatever, maybe he deserves it. Whether he listened to the beating of Washington Republican war drums pre-election, or maybe his experiences in and around Washington, it led him to publish this paper. Probably a bit of both. This podcast will summarise the paper and give some page numbers where relevant and offer some of my own opinions. According to Miran, in the executive summary, he says the root of the economic imbalances lie in persistent dollar overvaluation, which prevents the balancing of international trade, and this overvaluation is driven by inelastic demand for US dollar assets, allied to a strong and liquid dollar. American exceptionalism, if you like. As global GDP grows relative to US GDP, it becomes increasingly hard for the US to finance the provision of US global reserve assets and the defence umbrella, as the manufacturing and tradable sectors bear the brunt of the costs. Starting on page 3, Miran says that the Trump 1 presidency, tariffs were non-inflationary, instead deflation occurred in China. Miran goes on to say that many argue that tariffs are highly inflationary and can cause significant economic and market volatility, but he says that need not be the case. Indeed, a material increase in effective tariff rates in Trump 1 passed with little discernible macroeconomic consequences. The dollar rose by almost the same amount as the effective tariff rate, nullifying much of the macroeconomic impact by resulting in significant revenue to the US. He says this is because Chinese consumers' purchasing power declined with their weakening currency. China effectively paid for the tariff revenue. My pushback against this is that unfortunately the pandemic arrived in 2020 before the Trump 1 tariff process could fully play out. Also, probably shouldn't lose sight of the fact that the savings rate is high in China. Plus, overseas tourism was curtailed and China's housing oversupply. Further on page 3, the exorbitant privilege is not so exorbitant anymore as US GDP declines as a percentage of global GDP. From a trade perspective, the dollar is persistently overvalued in large part because dollar assets function as the world's reserve currency. I think this exorbitant privilege is great for the US, and it lets it print a paper dollar for a couple of cents or inject it electronically for zero marginal costs and purchase $1 worth of credit or goods and service. Miran maintains this overvaluation has made American manufacturing sector uncompetitive, benefiting the financial sector of the economy, whereby wealthy Americans profit. Still on page 3, is global protection worth paying for? Miran says the Trump administration can attempt to find ways to capture back some of the benefits other nations receive from the US reserve position. The reallocation of aggregate demand from other countries to America, making the US the consumer of last resort. This means tariffs would provide an increase in revenue to the US Treasury and help America bear the increasing cost of providing reserve assets for a growing global economy. The Trump administration then is likely to intertwine trade policy with security policy, viewing the provision of reserve assets and the security umbrella as inseparable. And this is what we are seeing post-April Liberation Day. On pages 5 and 6, Miran discounts classical comparative advantage trade theory in favour of the Tariff dilemma. Persistent overvaluation of the dollar is the key mechanism for trade imbalances, keeping imports from abroad stubbornly cheap despite widening trade deficits. So why don't currency markets, which are the largest markets in the world in the US, in terms of sheer trading volume, equilibrate? Miran says the answer lies in the fact that there are at least two concepts of equilibrium for currencies. One is rooted in classical models of international trade, whereby currencies adjust over the long term to balance international trade. If a country runs a trade surplus for a sustained period, it receives foreign currency for its goods, which it then sells for its domestic currency, pushing its domestic currency higher. That process occurs until its currency is strong enough that its exports decline and imports increase, balancing trade. The other equilibrium concept is financial and comes from savers selecting investment alternatives among different nations. We are certainly seeing this in the last 10 to 20 years. In this second model, currencies adjust to make investors indifferent between holding assets denominated in different currencies. And if we talk about American exceptionalism, the Mag 7, etc., then we can see that foreign capital flows into America. Thus arises the Tariff dilemma. Because America provides reserve assets to the world, there is demand for US dollars and US Treasury securities, USTs. That is not rooted in functions serving to balance international trade, but instead provides a vehicle for other nations' large pools of savings, often held for policy reasons, e.g. reserve or currency management or sovereign wealth funds, rather than return maximisation. Such phenomena reflect what can be described as a Tariff world after Belgian economist Robert Tariff. In the Tariff model, reserve assets are a form of global money supply, and demand for them is a function of global trade and savings, not the trade balance. When the reserve country is large relative to the rest of the world, there are no significant externalities imposed on the reserve country from its reserve status. Miran asserts that in this case the distance from the Tariff equilibrium to the trade equilibrium is small. However, when the reserve country is smaller relative to the rest of the world, say because global growth exceeds the reserve country's growth for a long period of time, the distance between the Tariff equilibrium and the trade equilibrium can be quite large. So demand for reserve assets leads to significant currency overvaluation with real economic consequences. And in a Tariff world, the reserve asset producer must run persistent current account deficits as the flip side of exporting reserve assets. Thus, US treasuries become exported products which fuel the global trade system. In exporting USTs, America receives foreign currency, which is then spent usually on imported goods. According to Miran, then America runs large current account deficits, not because it imports too much, but it imports too much because it must export USTs to provide reserve assets and facilitate global growth. I would push back a little on this by comparing a pair of scissors and asking which blade does the most cutting, the global demand for US assets or insatiable consumer demand. Remember, US saving rates are low, or to put it in terms of Trump's performative politics, a little American girl who has $20 or $30 really only needs 2 or 3. As the United States shrinks relative to global GDP, the current account or fiscal deficit it must run to fund global trade and saving pools grows larger as a share of the domestic economy. Therefore, as the rest of the world grows, the consequences for the US export sectors of an overvalued dollar become more difficult to bear. Eventually, well, in theory anyway, a Triffin tipping point is reached at which such deficits grow large enough to induce credit risk in the reserve asset, and the reserve country loses reserve status, ushering in global instability referred to as the Triffin dilemma. Indeed, the paradox of being a reserve currency is that it leads to permanent twin deficits, which in turn lead over time to an unsustainable accumulation of public and foreign debt that eventually undermines the safety and reserve currency status. Moving on to page 7 of the paper. Can the BRICS step up to the plate and take over? According to Miran, probably not, as a reserve currency must be convertible into other currencies on the capital account, and a reserve asset must also be a stable store of value governed by reliable rule of law. While other nations like China aspire to reserve status, they satisfy neither of these criteria. Hence, it's not surprising that the BRICS are looking at gold to supply the reserve currency muscle. But according to Miran, we are unlikely to see a return to the gold standard anytime soon, although there is ongoing speculation by some commentators. So the days of US generous tariffs of 3 to 5% are over. Miran says these are legacies of an era in which the United States wanted to open its markets to the rest of the world at advantageous terms to assist with rebuilding after World War II, and after that creating alliances during the Cold War. On page 8, Miran asserts that we are not at the Triffin tipping point just yet. Other commentators say maybe in the 2030s as Trump's big beautiful bill plays out. Moving on to page 9, reserve status and the high US dollar problem. Exporting nations accumulate reserves in part to stem appreciation, Japan being the historical example that has gone on for decades now. Miran does not point out that Japan's carry trade is the mirror image of the US imbalance. Now China can be added to the list, which would have much bigger consequences, although no renminbi conversion on capital account. Thus, Miran says exporters' dollar reserves tend to go up when the dollar is going down as they buy the dollar, that is, sell their currency to suppress the dollar, and vice versa, buy their currency when the dollar is going up. Miran says the interplay between US reserve status and the loss of US manufacturing jobs is sharpest during economic downturns, because the reserve asset is a safe haven. The dollar appreciates during recessions due to the US Treasury's flight to safety. By contrast, other nations' currencies tend to depreciation when they go through an economic downturn. That means that when aggregate demand suffers a decline, pain in export sectors gets compounded by a sharp erosion of US competitiveness, and employment in manufacturing declines and fails to recover materially afterwards. Some pushback by me on this is that capital is footloose and fancy-free, and American companies move their manufacturing offshore to lower costs. Of course, Republican hawks are now saying this was a mistake, but this is hindsight, and unfortunately China didn't fully democratize. I must admit the idea seemed good at the time. Page 10, reserve status and sanctions. If the reserve asset is the lifeblood of the global trade and financial systems, it means that whoever controls the reserve asset and currency can exert some level of control over trade and financial transaction. The dollar allows America to exert its will in foreign and security policy using financial force instead of military force. America can and does sanction people all over the globe in a variety of ways, from freezing assets to cutting nations off the SWIFT payment systems and restricting access to the US banking and financial system that is critical for any foreign bank doing global business. Of course, since Ukraine, there is concern from Russia's friends and emerging markets that this could happen to them. A little bit of economic history for me. Sanctions can be regarded as the modern equivalent of the old historical Navy blockades. Interesting to note that the US applied oil sanctions to Japan in World War II, and the Japanese only had 2 to 3 years of oil stockpiles, thus on borrowed time to dominate Southeast Asia, which proved too big an ask for Japan. Page 12. Trade policy and national security become intertwined. Miran says US interventions will be targeted at industrial plant critical to national security, to include products like semiconductors, pharmaceuticals, and now rare earths. The recent US Department of Defense rare earth to subsidise the domestic Mountain Pass mine to refine rare earths, with Mountain Pass halting shipments to China, maybe to close the deal, provides a good example. Interesting that in tariff negotiations, China has lifted rare earth tariff restrictions and gone down the export licence route. Tit for tat, you might say. Pages 13 to 17. Will there be tariff pass-through causing inflation? Miran says the classic way currencies offset changes in tariffs is that tariffs improve the trade balance, which then puts upward pressure on the currency for traditional reasons. You could argue that since Liberation Day we have seen the dollar going down, but then there's been some slight improvement as the deals are made. However, Miran also says currencies might also adjust because nations' central banks adjust interest rates to offset inflation and demand changing. So Miran is hoping a lot of things go right and that the optimal but narrow pathway where the exporting country devalues, and this offsets US tariff import inflationary effects. But of course, many are sceptical that American importers won't make a grab for cash along the import supply chain. That is, wholesale importers do not pass on foreign currency offset to retailers, who in turn don't pass on the offset to the consumer. Miran lists these trade-offs in Table 2 on page 17 of the paper, though of course reality may fall in between these extremes. Of course, like all two-handed economists, with perfect pass-through, the Treasury gets its tariff revenues. But on the other hand, if zero pass-through, then Miran assumes inflation is somehow contained, and over time, after J-curve pain for the importing country, domestic import substitution occurs. So sort of a win-win for both outcomes. Page 18, muscle up to China. While Miran is predicting that tariffs would settle between 10 and 20%, and this is a level which could be welfare enhancing for the importing country, he proposes a shock and awe approach to China as follows. Imagine a very large tariff on China, so a sharp increase in the effective tariff rate from 20% to 50%, offset by a 30% devaluation in the renminbi. This would most likely lead to significant market volatility because China's communist economic system necessitates strict control over the capital account to keep funds locked in domestic assets. There would be incentives to find ways around capital controls which may cause difficulty for their economy. Thus, capital outflows from China could potentially result in asset price collapses and severe financial stress. According to Bloomberg, total debt in the Chinese economy exceeds 350% of GDP, and this level of leverage entails the possibility for massive vulnerabilities to leakages in the capital account. Bursting bubbles in China as a result of currency devaluation could cause financial market volatility significantly in excess of that caused by the tariffs themselves. So this is a bit of a threat by Miran to sort of devalue China's currency and try and cause worries among their population. I don't know, the Chinese are pretty patriotic. and China has plenty of foreign dollar reserves to fight fire with fire. At the time of this podcast, it seems cooler heads on both sides are prevailing with ongoing discussions, but expects many twists and turns. In Australia, I think it was a smart move by the Albanese government to immediately concede on US beef, which is unlikely to penetrate much here because of the exchange rate difference, unless they loss lead. Wow, given high Aussie domestic beef prices, would this be welfare enhancing for us Aussie beef eaters? We should also mention the Genius Act, stable coins backed by US Treasuries. This could play a role in Chinese capital leakage, though so far it's aimed at emerging and developing markets where individuals might prefer to hold anything but their own currency, and foreign worker repatriation flows using blockchain protocols to undercut the more highly priced traditional channels, Western Union, etc. Page 19, a VAT by any other name. Miran bolsters his case saying that tariffs are a one-time increase in the price level and hence non-inflationary, and the US does not have a value-added tax, VAT like others, which taxes US exports, so the tariff is just a consumption tax on foreign imports, and the US is just starting at a not dissimilar base to other advanced nations. This one is difficult for exporting nations that export to America VAT-free. America says that their exports will have VAT added at the importing country, so their tariff is just a replacement for a VAT tax that they don't have. Page 20. How likely is currency offset to occur? Miran uses the Trump 1 China tariffs of 2018-19 to claim that currency offset was effective, but concedes there were several cross-currents at the time that make the comparison cloudy. So this is not really convincing. Page 21. The US is the least worst deficit country. Miran hopes, given many other nations' precipitous demographic trends, they too have severe budget problems lurking in their future as well, even if their primary deficits are not projected to rise as much. Moreover, he maintains that because tariffs raise revenue, the tariff revenue will help to moderate the US fiscal deficit. So the plan is to weaken the US country to favour domestic substitution, but not enough to bring the bond vigilantes riding in to rein in the US fiscal deficit. As they say, a fine line between pleasure and pain, or should I have said a narrow pathway to the new equilibrium away from the Triffin dilemma. On page 21, Miran addresses tariff implementation. In the November paper, he proposes that the second Trump administration should go gently with tariff implementations. Put the ball in China's court for reforming their economic system. Allow tariffs to exceed 60% midway through the term, which is something President Trump has expressed wanting. 60% is a starting point. Provide firms with clarity over the path for tariffs, which will help them make plans to deal with supply adjustments. Well, the last 2 points definitely haven't gone to plan. Maybe because Trump in his first presidency may have felt dudded by China, and he knows realistically he has only 2 to 4 years, so he's going fast and hard this time. Page 22, enter Scott Bessant. At the time of publishing his paper, Miran presents Scott Bessant as a Trump advisor, being floated as a potential Treasury Secretary. Obviously, this came to pass. Before being appointed, Bessant had proposed putting countries into different groups based on their currency policies, the terms of their bilateral trade agreements and security agreements, plus their values and more. These buckets would bear different tariff rates and the government can lay out what actions a trade partner would need to undertake to improve their position in the bucket list. As an aside, I can't help saying Australia's move on beef might not be enough in the long run, with US demanding that we move to 3% of GDP for defence expenditure. And while I am here, can Australia claim leasing or buying the Virginia-class submarines as part of the 3%? What do they say? Laugh out loud? On page 23, Miran gives the laundry list of these requirements to have privileged access to the US consumer. Does the nation apply similar tariff rates to their imports from the US as America does on their exports here? Does the nation have a history of suppressing its currency, for instance via the accumulation of excessive quantities of foreign exchange reserves? Does the nation open its markets to US firms in the same way America opens its markets to foreign firms operating stateside? Does the nation respect American intellectual property rights? Does the nation help China evade tariffs via re-export? Does the nation pay its NATO obligations in full? Does the nation side with China, Russia and Iran in key international disputes, for instance at the United Nations? Does the nation help sanctioned entities evade sanctions or trade with sanctioned entities? Does the nation support or oppose US security efforts in various theatres? Does the nation harbour enemies of the United States, e.g. terrorists or cybercriminals? Do the nation leaders grandstand against the United States in the international theatre? That's the list if you want to be in the club. Page 23. It's the geopolitical economy and fiscal imbalance, stupid. Thus national security and trade are joined at the hip. In Besant's words, trade terms will more clearly segment the international economy into zones based on common security and economic systems, and this would help highlight the persistence of imbalances and introduce more friction points to deal with them. This is a convoluted way of saying countries that want to be inside the defence umbrella must also be inside the fair trade umbrella. Miran likes this, saying, from America's perspective, if other nations choose to keep their current policies vis China but accept the higher US tariff, that's not terrible. At least they're paying revenue to Treasury and limiting the security obligations of the United States. Since becoming Treasury Secretary, Besant has gone on record as saying China as an export-oriented economy has more to lose than the US. Page 25. Tariffs can be welfare enhancing. Indeed, as long as tariffs don't exceed 50%, they are still welfare enhancing relative to completely open trade. That is, increasing effective overall tariffs from currently lower levels near 2% will actually boost aggregate welfare in the US. But once tariffs begin increasing beyond 20%, they become welfare reducing. Miran at that time also said investment houses were now projecting that Trump's tariffs will jump from 2 to 3% to 17%, just shy of the 20% level. Indeed, this is what we are seeing post-Liberation Day, approximately. Page 26, America First. Miran asserts that while preventing retaliation will be of great importance, the United States has a large source of global consumer demand with robust capital markets, can withstand a tit-for-tat escalation more easily than other nations, and is likelier to win a game of chicken. By joining national security with trade policy explicitly, America could declare that it views joint defence obligations and the American defence umbrella as less binding for nations which implement retaliatory tariffs. So at the time of this podcast, maybe it's worked, at least with Europe. stepping up to the plate to increase defence expenditure, and von der Leyen caving into 15% tariffs on European exports with no reciprocal retaliation. All agreed to between Trump's Scottish golf rounds. Although, let's be realistic, pharmaceuticals and semiconductors remain on the table. No doubt more twists and turns to come. Page 27, the elephant in the room, the bond market. Okay, so far so good, except for the $37 trillion US fiscal debt. Miran addresses this elephant, stating, the principal risk of pursuing a lower value dollar is that the policy intervention makes dollar assets less attractive in the eyes of foreign investors. To move away from the Triffin extreme to a more balanced outcome, he gives the example of a US 10-year bond yielding 4.25%. The bondholder could expect a 15% reduction in their holdings, representing almost 4 years' worth of interest payments and over a third of all the expected interest over the bond's life. For shorter-term debt, 3-year treasuries, it's worse. At 4.1%, the devaluation would eat more than all the expected interest. That is, the shorter-term bondholder loses money over the life of the security. This used to be known as bondholders taking a haircut, or today, taking one for the team. Miran worries that because significant portions of the US economy, for example housing, are tied to the belly and long end of the yield curve, this would have material adverse consequence if the Fed is forced to act to contain inflation. With regard to equities, Miran maintains that the big US multinationals will be better off as their foreign earnings increase with US dollar devaluation. But he neglects to point out that they have to be repatriated, keeping in mind during Trump 1, Trump was trying to jawbone these companies to bring the money home. Only the small problem of the CGT, capital gains tax, I suspect. One wonders, could there be a quid pro quo whereby no CGT on repatriation as long as you build stuff here? In the past, though, global financial panic has led to a flight to US treasuries, even when the problem started in the US. I hate to say it, but this time may be different, or don't worry until the 2028 election when the US fiscal debt goes above 40 trillion and Trump's boom has played out. Page 28, the Mar-a-Lago Accord, Plaza Accord 2.0. Historically, multi-currency accords have been the principal means of implementing intentional changes in the value of the dollar. The 1985 Plaza Accord, in which US, France, Germany, Japan and the UK coordinated to weaken the dollar, and then the follow-up 1987 Aluva Accord, which holded such weaknesses, are generally regarded as ways of adjusting currency levels, though their economic consequences are somewhat disputed. Does this mean, given the Aluva Accord reversal, that you can't have your cake and eat it too? As Miran points out, the trouble is that gross US debt to GDP is now over 120%, but only around 40% when the 1985 Plaza Accord was agreed. Page 28 and 29. US guns for you to give us some interest rate relief. Miran refers to a guy called Pozar, who's an ex-Treasury Secretary guy, I think it's Hungarian, Pozar, who suggests, 1. Security zones are a public good and countries on the inside must fund it by buying treasuries. 2. Security zones are a capital good. They are best funded by century bonds, not short-term bills. 3. Security zones have barbed wire. Unless you swap your bills for bonds, tariffs will keep you out. Obviously, Miran points out that these sort of deals shifts interest rate risk from the US taxpayer to foreign taxpayers and requires the stick of tariffs and the carrot of the defence umbrella and the risk of losing the defence umbrella to try and move in this direction. Personally, I don't think security zones as a capital good will fly, as capable countries, both big and small, would rather look after their own defence, especially where industrial policy is concerned, but still happy to import US weapons. Australia is a good example of this, with local defence manufacturing offsets often used for big weapons programs. Developing countries and emerging markets are likely to stay non-aligned, let alone commit to a 100-year capital good bond when they are probably already cash-strapped. Page 35. Tariff dollars or investments behind the tariff wall. Miran rightly points out that because of the large US fiscal debt, it pays to be more cautious with changes to dollar policy than with changes to tariffs. He says tariffs are a tool for negotiating leverage as much as for revenue and fairness. So the question is, will the exporting country relocate to the US and go behind the tariff wall? Japanese manufacturers did this in the 1980s under US pressure and the 1985 Plaza Agreement. And Trump himself has indicated he would welcome China building, among other things, auto factories in the United States. Miran points out that European real GDP growth has been below 1% for almost 3 years, and the rise of the Chinese auto export industry has Europe so concerned it is implementing its own set of protectionist measures. Meanwhile, Chinese domestic growth has been so weak that China has chosen to double down on its mercantilist export-led model to secure marginal income, much to the rest of the world's consternation. Miran is realistic, stating neither Europe nor China will be in a mood to curtail their industrial subsidies and other market interventions that would reallocate tradable manufacturing demand away from themselves and towards the United States. I think even if they did, would US workers, or rather robots, just screw in a few bolts to connect the imported sub-assemblies? A bit like the recent Apple deal, where hardened glass cases for the phones will be made in Kentucky, but the electronics come from China, or maybe India now. In Australia, in defence offsets, they used to call it metal bashing. Who knows, maybe sub-assemblies from Mexico would get under the radar, as Trump is always up for a deal. Page 36. Drill, baby, drill. Because reducing inflation is critical to helping alleviate bond market concerns, as well as allowing the Fed to pursue a deeper cutting cycle. Remember, Miran is now on the Fed board. Miran said back in November a Trump administration is likely to prioritise structural policies that reduce inflation via supply-side liberalisation. This means aggressive deregulation and a concentrated effort to reduce energy prices. This combination is bearish oil prices and quite bullish for equities. Thus, we might see pipelines and more mining in US government-controlled land, such as national parks, etc. Page 29 to 30. Who holds the debt and what might they do? Miran points out that these days most currency reserves are held by Middle Eastern and Asian trading partners rather than European trading partners. A list of the major foreign holders is as follows. Eurozone 280B, Switzerland 800 billion, China 3 trillion, official reserves, but this could be decreasing now with the BRICS initiatives. Japan 1.2 trillion, India 600 billion, Taiwan 560 billion, Saudi Arabia 450 billion, Korea 420 billion, Singapore 350 billion. This adds up to around 8 trillion. So most of the dollars available to be sold by governments in the hands of Middle and East Asian regimes, and some of these nations are not as friendly as the Europeans were during the Cold War. Miran assumes assets held for these reserve purposes, though, are less likely to flee than assets held for wealth maximisation. So what is the domestic situation? At the time of this podcast, using updated figures based on a 37 trillion US fiscal debt, Fed and other US governments hold 12 trillion, that's 33% domestic. Domestic private holdings, 15 trillion, 42%. Foreign holdings, that's private foreign holdings, 9 trillion, 25%. So foreign holdings seem close enough to Miran's November 2024 figures, give or take $1 trillion. The 42% domestic holding is held by private sector investors, both institution and retail, and a run by these investors has potential to tip the current balance. I personally wonder, are insurance and pension funds happy that their liabilities match their US Treasury assets along the yield curve and would ignore a capital loss at the long duration end? A simplistic indicator might be to watch if the 30-year yield goes above 5%. This is what slowed down the tariffs previously. Recall Trump saying people were getting a bit yippy, and that's when the 3-month delay came into force after Liberation Day. So, not surprisingly, on page 36, a smaller elephant, US Treasury issuance moving from long-term bonds to short-term bill. Miran points out that he and Roubini in 2024 recommended shortening the maturity profile of its debt. As an aside, it's interesting to note that Roubini, who predicted the GFC, said the US will grow at 4% due to AI. If this came to pass, then most of the problems would go away as productivity growth outpaces US Treasury debt issuance. But let us not forget Piketty's Capital in the 21st Century book, where returns to capital outstrips returns to labour due to technology, etc. So in this case, could the company tax rate be increased if these 4% growth rates are realised? Alternatively, the equity market would definitely boom even more. Back to the paper, as Miran says, the US Treasury can reduce supply of duration to offset the increased supply that occurs as a result of foreign sales. The justification in this context would be to buffer volatility during foreign selling. According to Besant, the before-mentioned Genius Act could help to keep the wolf from the door, my words, not his, as he sees a $3 trillion market for US Treasury-backed stablecoins run by private exchanges. Is this a return to the older days of when banks issued their own private banknotes and promised to pay the bearer, etc., etc.? Didn't always work out. Financials probably would like this, as the short-term Treasury bills could be lent out by the exchanges for speculative and hedging purposes. Quite a this goes on already. Okay, page 32, revaluation of Treasury gold. Finally, gold rears its head in the Miran paper. The US Gold Reserve Act authorises the US Treasury Secretary to sell gold, but it is required to use the process to reduce the national debt. The amount raised at current gold prices would be around $800 billion. Instead of selling the gold to directly reduce debt, Miran wants to use it to buy foreign exchange, an extension of the Exchange Stabilisation Fund, and may be marketed as a sovereign wealth fund to lower the dollar. He maintains this requirement can be reconciled with the goal of building foreign exchange reserves, which would at least pay interest, unlike gold, although he foresees issues. So I guess the idea is that when foreigners buy the dollar, the gold money is used to stabilise by selling the dollar, and when foreigners are selling the dollar, the gold money is used to buy the dollar. The question becomes, how far can 800 billion go? Hopefully a year or two, but I don't know much about Forex markets. Is chaos about to start? As a coder, at the time of this podcast, the de minimis provisions, which are no longer tariff-free entry for goods less than $800, have come into force. We are going to hear lots of small Australian export businesses complaining their business models, that is, re-exporting from China to the US, have been compromised. So the usual conclusion of all economists, will the costs of the tariffs outweigh the benefits to the US economy? It certainly will be bad news for the rest of the world's exporters who rely on the American consumer. Hope this review was useful. Thanks for listening. Bye for now.